welcome back to the deep dive. Today, we are opening up what is, it's arguably the most important document in the history of modern finance.
That's a big claim, but I think it's true.
Right. We are looking at Benjamin Graham's The Intelligent Investor. But, and this is the key thing, we aren't just looking at the original from, 1949? We're specifically unpacking the revised edition, the one with the commentary by Jason Zweig, which is so crucial. It bridges this gap, doesn't it?
It totally does. It takes Graham's post-depression world and plugs it right into our modern algorithmic chaos. It's like a conversation between two eras.
And before we get into like PE ratios and all that, I want to reframe what this book actually is. I think people assume it's a math book.
Yeah, how to read a balance sheet.
Exactly.
Yeah.
And it is, partly.
Yeah.
But reading it, it really struck me that this is a psychology book. It's a manual on emotional regulation.
That is the perfect way to put it. Graham figured this out so early. You can be a mathematical genius, but if you can't control your own emotions, the market is just going to destroy you.
So it's not about beating the market.
It's about mastering yourself.
And there's no better proof of that than the story of Sir Isaac Newton. This anecdote, it completely floored me. I mean, I knew Newton was a genius, calculus, Graham.
The laws of motion, yeah.
But I had no idea he was such a terrible investor.
He was the victim of one of the first big bubbles, the South Sea Company, back in 1720.
So walk us through this, because it's not that he just got a bad stock. It's how he lost the money. That's the whole point.
Right. So Newton gets in, the stock starts rising, and he senses things are getting a little frothy, as we'd say today.
So he does the smart thing. He sells.
He sells. And he pockets a profit of 7,000 pounds, which in 1720 is just a life-changing amount of money. He won. The game's over.
If the story ended there, he's an investing genius.
But it doesn't. The stock keeps going up and up. And Newton is watching his friends, people he probably thought were not as smart as him, getting absolutely rich.
Oh, the pressure.
And it breaks him. He jumps back in, right at the absolute peak.
So the FOMO.
Yeah.
It got Sir Isaac Newton.
It did. And almost immediately, the bubble burst. Stock collapsed. Newton lost 20,000 pounds.
Which in today's money is what, millions?
Oh, millions. He was wiped out. And he famously said, "I could calculate the motions of the heavenly bodies, but not the madness of the people."
That quote is the anchor for this entire deep dive. If the guy who invented calculus couldn't figure out the market with math, what chance do we have?
Zero chance. And that's the point. Graham's whole idea is that investing intelligence, it's a character trait. It's not a brain thing. It's having a framework to stop your emotions from costing you money.
Okay, so let's build that framework for everyone listening. We've basically organized this into 4 big ideas from the book. First, we have to draw a hard line between investing and speculation. Second, we'll look at the silent enemy, inflation.
Something we all know a little too well lately.
Right. Third, we'll tackle market history and what the book calls bull market baloney. And finally, we get practical with the strategy for the defensive investor.
Mindset, then mechanics. Love it.
So let's start with that definition. Investing versus speculation. Today, those words are basically the same thing. You buy a crypto coin, you're an investor.
Graham despised that. He said Wall Street does a huge disservice by blurring those lines. For him, the definition was incredibly rigid. 3 parts.
Okay, what are they?
He said, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
I want to focus on safety of principal. He doesn't mean you can never lose money, right? That's impossible.
No, not that the price can't go down. He means safety from permanent loss. If you buy a good company at a fair price, the stock might dip, sure, but the underlying value is there. It protects you from getting wiped out.
A speculator, on the other hand, could see their asset go to zero.
And stay there. And that third part, adequate return, is just as important. He doesn't say extraordinary or massive return.
Right. An investor wants a fair return. A speculator is looking for the lottery ticket.
Exactly. They want to turn $1,000 into $100,000. Graham says if that's your goal, fine. But don't call it investing. You're gambling.
The book uses a really good analogy about driving speed.
Yeah, it's perfect. Investing is like driving 65 miles per hour on the highway. It's the standard speed you'll get to your destination.
And speculating.
That's driving 130. Now, you might get there faster. You might even survive. But if you do, it doesn't mean you were a smart or safe driver. It just means you got lucky.
And you can't build a financial future on luck. Which brings us to these sure thing formulas. The Zweig commentary is just, It's brutal on them.
It's a graveyard of failed algorithms. A classic one is the January effect.
That was the idea that small stocks always do great in January, right?
Yep. And for a while, the data backed it up. People would sell losers in December for tax reasons, prices would drop, and they'd pop back up in January. A predictable bounce.
So why did it stop working?
Well, because everyone found out about it. Once the secret was out, everyone tried to get ahead of it, buying in December. The opportunity just, it vanished, arbitraged away.
And there was another one, the Foolish Four. Sounds like a bad boy band.
It was huge in the 90s. Incredibly complex formula. Take the Dow stocks, rank by yield, divide by the square root of the price. It all looked very scientific.
But the book calls this data mining.
That's all it was. If you torture the data long enough, it'll confess to anything. Zweig points out you could have found a pattern where stocks with non-repeating letters in their name did well. It's just noise.
So what happened when people actually used it with real money?
It failed. It underperformed and then collapsed.
So if formulas are a trap and our gut feelings are a trap, are we just not allowed to speculate at all? Humans like to gamble.
Graham was a realist. He knew that. So he offered a compromise, the Mad Money account.
The idea being, if you absolutely must speculate.
You have to fence it off, limit it, strictly 10% of your assets maximum. And he was really specific about the logistics.
Put it in a separate account.
Well, a completely separate account. Never mix your gambling money and your serious money. And most importantly, never mix the thinking. Don't let a lucky win in your Mad Money account convince you that you're a genius who should gamble with the Ren money.
It's like a casino budget. When it's gone, you're done. No trips to the ATM.
That's the only way to do it safely.
All right, so we've fenced off the gambling. Now for our actual savings. And there's this thing eating away at it while we sleep. Segment 2, inflation.
The silent enemy. And this is so hard for our brains to grasp because of what Graham called the money illusion.
Explain that, because I feel like I get inflation prices go up, but the illusion part suggests I'm tricking myself.
Okay, here's a quick test. Imagine you get a 2% raise, but inflation is 4%.
Okay, so I'm actually poorer. My purchasing power is down.
Right, but you feel okay, maybe even good, because the number on your paycheck went up.
I see more dollars, I'm happy.
Now, imagine inflation is 0, but your boss cuts your pay by 2%. You'd be furious. But in terms of what you can actually buy, those two scenarios are identical. That's the money illusion. We focus on the number, not the value.
And the book points out that in the U.S., we kind of think high inflation is something that only happens elsewhere.
It's a dangerous bias. The data shows that since 1960, almost 70% of market economies have had at least 1 year of 25% inflation, and the U.S. is not immune.
What was our worst period?
From 1973 to 1982, the U.S. dollar lost half of its purchasing power.
Half.
Half. 100 grand under the mattress in 73 was only worth 50 grand by 82. You lost half your wealth doing nothing.
So the common wisdom is buy stocks. Stocks beat inflation. But the book says, not so fast.
Over the very, very long term, yes. But in the short term, when inflation really spikes, say above 6%, stock returns often go negative. It squeezes corporate profits. It messes with the economy.
So you can't just throw everything in an S&P 500 fund and call it a day.
It's not a perfect shield.
So what are the real shields? The text mentions 2 specific tools.
The first is REITs, real estate investment trusts. These are basically companies that own buildings and collect rent.
And the logic is, when prices go up, landlords can raise rents.
Exactly. You're owning the thing that's a primary driver of inflation. The second tool is TIPS, Treasury Inflation Protected Securities.
Government bonds.
Right, but with a twist. The principal value of the bond automatically adjusts upward with the consumer price index. So if inflation goes up 5%, the value of your bond goes up 5%.
So your purchasing power is guaranteed.
It's the only asset that does that. But there is a nasty little catch, the taxes.
It's a phantom income problem. Explain that.
So when your bond's value goes up with inflation, the IRS counts that as income for the year, even though you haven't been paid any cash.
So you're paying real cash taxes on paper gains? That sounds awful.
It is, which is why the advice is almost always to hold tips in a tax-sheltered account like an IRA. Keep them out of your regular brokerage account.
Okay, so we're fighting inflation. Now let's talk about the market itself. Segment 3, history and ignoring bull market baloney.
My favorite technical term.
This is all about how we project the future, right?
Yeah.
When the market's hot, our brain just draws a straight line going up forever.
Graham called it the rule of opposites. He said the more enthusiastic the public becomes about the market, the more dangerous the market actually is.
So when your dentist is giving you stock tips?
That is not a buy signal. That is a signal that all the good news and therefore all the risk is already priced in.
There's this great Michael Jordan analogy in the commentary to explain valuation. This really makes it click.
It's a great visual. Okay, so Michael Jordan in his prime, the Chicago Bulls paid him, what, $34 million a year? Was he worth it?
Absolutely. Championships, ticket sales, merchandise. He was a great investment for them.
Right, but what if they decided to pay him $34 billion a year?
The team goes bankrupt. Instantly.
But notice, Jordan is the same player, same jump shot. The asset is identical. At $34 million, he's a brilliant investment. At $34 billion, he's a financial catastrophe.
A great company isn't always a great investment.
It depends entirely on the price you pay.
And we get tricked into overpaying by looking at historical charts. The Dow goes up for 100 years and we think it's a sure thing. But the book warns about survivorship bias.
Yes, the index only shows you the winners. It ignores the thousands of companies that went bust, all the canal companies, the turnpike companies, the dot-coms that went to zero. The index is a highlight reel, not the full game tape.
So how do we know if we're paying too much? Is there a metric?
The most reliable one discussed is the Shiller P/E ratio. It compares the current stock price to the average earnings over the last 10 years, adjusted for inflation. It smooths out the noise.
And what does history show?
It's pretty consistent. When that ratio gets way up above 20, the returns for the next decade are usually pretty bad. When it drops below 10, the returns that follow are usually fantastic. It doesn't tell you the future, but it tells you the climate.
Okay, this is the perfect transition to the final, most practical part. The solution. The strategy for the defensive investor.
And defensive doesn't mean you're scared of the market. It means you want to defend your time. You don't want investing to be a second job.
That's me. That's most people. So what is the actual rule?
It's beautifully simple. A mechanical asset allocation, the 50-50 split. Half your money in high-grade bonds, half in a diversified basket of stocks, like an index fund.
That sounds almost too simple.
The simplicity is the point.
Yeah.
The genius is in the maintenance. It's the rebalancing.
Walk us through how that works.
Okay, you start with $10,000, $5,000 in stocks, $5,000 in bonds. A year goes by, market's hot, your stocks are now worth $6,000.
Well, now I'm at 55% stocks. I'm making money. I'm happy.
But the rule says you have to be 50-50. So you are forced to sell $500 of your stocks and use that money to buy bonds.
I have to sell the winner. That feels so wrong.
Emotionally, yes. But mathematically, what did you just do? You sold high, you took profits, now flip it. The market crashes. Your stocks are now worth $4,000.
So I'm underweight stocks.
And the rule forces you to sell your safe bonds and buy stocks.
When everyone else is panicking and selling.
You're automatically buying low. The rebalancing isn't just about diversification. It's an automatic system that forces you to be a contrarian. It automates buy low, sell high.
Now, what about that old rule of thumb? The age rule. Subtract your age from 100 to get your stock percentage.
Zweig's commentary just rips that apart. It's way too rigid. The book argues your allocation should depend on your circumstances, not your birthday.
Give me an example of where that rule just breaks.
Okay, an 89-year-old widow, she's got millions, lives simply, and wants to leave it all to her grandkids. The age rule says she should be almost all in bonds.
But she doesn't need the money.
Exactly. She has a huge risk capacity.
Yeah.
Her real-time horizon is her grandkids' lifetime, not hers. She can afford to ride out a crash.
And the opposite, a
Like-
25-year-old.
Right. A 25-year-old saving for a down payment on a house he wants to buy next year. The rule says he should be 100% stocks. But what if the market crashes 40%?
His down payment is gone. His life is totally disrupted.
He needs stability more than he needs growth in that moment. It's about when you need the money, not how old you are.
Okay, one last technical point. On the bond side, why intermediate bonds? Why not just get the highest yield from a 30-year bond?
Because of duration risk. Long-term bonds are super sensitive to interest rates. If rates go up just a little bit, a 30-year bond can lose a huge amount of value. It can behave almost like a stock.
Which defeats the entire purpose of it being the safe part of the portfolio.
That's the danger. Intermediate bonds, say 5 to 10 years, are the sweet spot, the seesaw. They give you some yield, but they don't crash nearly as hard when interest rates move. They're the real ballast for the ship.
Okay, so to recap this whole journey, we've defined the investor who demands safety versus the speculator who's just driving 130 miles an hour.
We talked about the money illusion and how to use things like tips and REITs to actually fight inflation.
We debunked the bull market baloney, the idea that a good company is always a good investment no matter the price.
And we laid out the practical defensive strategy. the 50-50 split, and the crucial discipline of rebalancing.
It all comes back to that pendulum image from the book.
It does. Graham said the market is a pendulum, always swinging from unsustainable optimism, which makes stocks too expensive, to unjustified pessimism, which makes them too cheap.
And the intelligent investor.
Is a realist who sells to the optimists and buys from the pessimists.
Which leads us perfectly to the final thought, the one quote that just sums up this entire book. The investor's chief problem, and even his worst enemy, is likely to be himself.
That's the ultimate truth. You can have all the data, the best software, the highest IQ, but if you can't control your own fear and your own greed, you will lose to someone who can. The intelligence Graham is talking about, it's emotional intelligence.
So the next time you feel that FOMO, that panic, just remember Sir Isaac Newton. Don't try to be a genius, be disciplined.
Be the intelligent one in the room.
Thanks for listening to The Deep Dive. We'll see you next time.